Hi, my name's Anna Marie Mock, and I'm a fee-only certified financial planner at Highland Financial Advisors. If you like my content, please click on subscribe below, and you'll get notified of any new videos as they're released. Savvy investors and pharmaceutical executives are always looking for ways to reduce their tax liability and increase charitable donations. Today we're going to talk about the benefits and some helpful tips on donating appreciated stock and equity compensation. By leveraging appreciated assets like stock, the donor can 1, support the causes that they care most about, and 2, reduce their tax liability. The donor, in the year of the contribution, can deduct the fair market value up to certain limits on their tax return. And this is hugely impactful because it avoids triggering capital gains, it reduces taxable income, and it gets any future appreciation out of their net worth and estate. It also allows the donor to reduce concentration to one particular stock. And this ultimately leads to diversification of the portfolio and reduction in risk over the long run. Donors can also preserve liquidity to use for other financial needs because, hey, they're not using the cash they have on hand, they're using stock that they currently have in their portfolio. This also has a lasting impact on the organization itself, because as the asset grows, they could use it for ongoing support and long-term sustainability. So, what kind of stock is available and eligible to donate? Well, the first kind is just public stock that the donor has in their name. It gets a little bit nuanced when we talk about equity compensation. For example, restricted stock units have to be held 1 year from the vesting date. Before the year is up, it makes sense just to sell out of the RSU and donate the cash itself. For non-qualified stock options, it has to be held 1 year from exercise. And for incentive stock options, it has to be held 1 year from exercise and 2 years from the grant. Also be mindful of any AMT or alternative minimum taxes that are triggered at that donation as well. So, how do you actually donate the stock? Well, it has to go to a 501c3 charity. In the year of the donation, the donor can actually deduct 30% of their AGI on their tax return. But this is where I suggest that you go to an accountant to discuss this because they'll know your unique circumstances and how that dynamic works. A really simple tool for you to utilize is something called a DAF, a donor advised fund account. This will help facilitate the donation process and just simplify it for you. You can deduct up to 50% of your AGI in the year of the contribution. So this is an extremely powerful tool when you have a year with really high income. The assets will continue to grow in the DAF, and you can give charities donations on an annual basis. You also want to be mindful of donating low-cost basis stock to either the charity directly or to the DAF. And there's a couple reasons why. Let's use an example. If you have a stock that vested at, say, $80 versus a stock that vested at $20, and they're both worth $100. If you donate the first stock at $80, that vested at $80, you're only saving about $20 capital gains. However, if you donate the one that was vesting at $20, you're saving $80. And if you're in the highest capital gains rate of 20%, that's $16 per share. So that's pretty significant in the current year, and that also is very powerful over the coming years as that stock continues to grow. To sum up, this type of donation is really empowering to the donor because 1, they can support the causes they care about, and 2, they can reduce their own tax liability. If you want to chat, please click on the link below to schedule a free initial consultation. Thanks, see you next time.